What is Direct Tax Code? The Direct Tax Code is a proposed legislation aimed at simplifying, consolidating, and streamlining the direct tax laws in India. It seeks to replace the existing 63 years old Income Tax Act, 1961, and related laws governing direct taxation. The purpose of the DTC is to make tax laws more efficient, reduce ambiguity, and ensure tax compliance while keeping pace with economic developments. Introduction to Direct Tax. Direct tax is a type of tax that is directly levied on individuals and entities by the government. It is called direct because the tax burden falls directly on the taxpayer, unlike indirect taxes such as the Goods and Services Tax, GST, where the burden is passed on to consumers. Common forms of direct taxes include income tax, corporate tax, wealth tax, capital gains tax, and inheritance tax, though some of these are now abolished in India. Why need for the Direct Tax Code? India's Income Tax Act, 1961 has been in force for over 6 decades. Over the years, it has seen numerous amendments and changes, resulting in complexity, ambiguities, and inefficiencies. The DTC was proposed to overhaul this legislation and make direct tax laws more transparent, simple, and easier to comply with. The primary objectives of the DTC are: 1. Simplification of tax laws. The existing tax law has many exemptions, deductions, and varying tax rates, making it cumbersome for taxpayers to navigate. The DTC aims to streamline these provisions. 2. Widening the tax base. The DTC seeks to bring more taxpayers into the tax net, reduce tax evasion, and enhance revenue collection for the government. 3. Facilitating compliance. Simplified tax structures help taxpayers understand their obligations better, thereby encouraging voluntary compliance. 4. Consistency with modern economy. The DTC reflects the needs of a modern and dynamic economy, incorporating provisions related to digital transactions, international taxation, and business models. Key features of the Direct Tax Code. 1. Uniformity in tax rates. The DTC proposes uniformity in tax rates for individuals and businesses, with clear provisions for different income groups. For individuals, the tax slabs would be simplified, and for corporations, tax rates could be lowered to make Indian businesses more competitive globally. For instance, for individuals, the tax structure may have slabs such as 10%, 20%, and 30% for different income levels, with a broader definition of taxable income and fewer exemptions. For corporations, the DTC proposes a simpler tax regime with lower rates, possibly around 25% to 30%, to align with global standards. 2. Elimination of exemptions and deductions. The DTC seeks to reduce the number of exemptions and deductions available under the current Income Tax Act. For example, provisions like Section 80C, which allows deductions for investments in specific savings schemes, and House Rent Allowance, HRA, would be rationalized or merged into a streamlined deduction framework. The idea is to lower tax rates by eliminating the need for numerous exemptions and simplifying the tax return filing process. 3. Capital gains taxation. The DTC proposes significant changes in the taxation of capital gains. Under the current regime, long-term capital gains and short-term capital gains are taxed differently, with LTCG enjoying tax benefits. The DTC aims to rationalize these tax structures. For instance, uniform holding period. The holding period for determining whether an asset is long-term or short-term might be made consistent across all asset classes. Indexation benefits. Under the current regime, taxpayers enjoy indexation benefits, adjustment of purchase price for inflation, when calculating capital gains on long-term assets. The DTC may standardize indexation or limit its application. Simplified rates. Capital gains could be taxed at a flat rate rather than the current bifurcation between short-term and long-term gains. 4. Corporate taxation. The DTC aims to simplify the corporate tax structure to reduce tax disputes and litigation. By lowering the tax rates for companies and minimizing exemptions, the DTC seeks to improve ease of doing business and attract foreign investment. For example, under the DTC, provisions related to minimum alternate tax, MAT, which ensures that companies pay a minimum amount of tax even if they have low taxable income due to exemptions, might be simplified or abolished to reduce tax complexity. 5. Taxation of non-residents and foreign companies. To address the evolving global economy, the DTC would include comprehensive rules on the taxation of non-residents, foreign companies, and cross-border transactions. This includes: 1. Provisions related to permanent establishment, pay, to tax foreign companies that have substantial business activities in India. 2. Rules on controlled foreign corporations, CFCs, to ensure Indian residents do not shift profits to low-tax jurisdictions. 3. Alignment with international standards like OECD's Base Erosion and Profit Shifting, BEPS, norms to prevent tax avoidance through artificial profit shifting. 6. Anti-avoidance measures. To curb tax evasion and aggressive tax planning, the DTC proposes stronger anti-avoidance rules, including General Anti-Avoidance Rule, GAR. GAR would allow tax authorities to deny tax benefits for transactions that are primarily designed to avoid taxes. 7. Wealth tax. Though wealth tax was abolished in 2015, the DTC may reintroduce it in a simplified form to tax individuals or entities holding substantial wealth or assets beyond a certain threshold. This would help the government ensure equitable taxation of the wealthy. Benefits of the Direct Tax Code. 1. Simplified tax structure. By reducing the number of exemptions, deductions, and varying rates, the DTC would create a simplified and easy to understand tax structure for both individuals and businesses. 2. Transparency and clarity. The DTC would minimize ambiguities in tax laws, making it easier for taxpayers to understand their obligations and reducing the scope for litigation and disputes. 3. Widening the tax base. By removing complex exemptions and tax shelters, the DTC would bring more people and entities under the tax net, ensuring higher revenue for the government. 4. Global competitiveness. A simpler tax regime with lower corporate tax rates would make India a more attractive destination for foreign investment and businesses. Challenges and criticisms of the DTC. 1. Implementation issues. Transitioning from the existing system to the DTC could be challenging, especially for small businesses and individual taxpayers used to the older tax structures. 2. Revenue impact. While simplifying the tax structure, the government might face challenges in ensuring revenue neutrality, as lower tax rates could potentially reduce revenue if not counterbalanced by a broader tax base. 3. Complexity of compliance. Despite the goal of simplification, the DTC's anti-avoidance rules and foreign taxation provisions may add complexity for multinational corporations and high-net-worth individuals. Examples. A. Simplified income tax rates. Suppose a salaried individual earning 10 lakh rupees currently falls under the 20% slab, with deductions under Section ATC and HRA. Under the DTC, the individual may have to pay tax at a lower flat rate without claiming these deductions, leading to simplified compliance. B. Corporate tax. A company operating in India currently paying a 25% corporate tax rate may see that rate reduced to 20%, with fewer exemptions under the DTC. This would reduce compliance costs and encourage greater investment. Conclusion. The Direct Tax Code, DTC, is a transformative step towards simplifying and modernizing India's direct tax laws. By aligning the tax structure with the needs of a dynamic economy, the DTC aims to enhance compliance, broaden the tax base, and ensure long-term economic growth. However, successful implementation will require careful planning, addressing challenges, and managing the transition from the current tax regime.